Dustin, so good to see you. Today we start with an important question. Are you taking on too much risk? We have 4 signs that you might be. Risk isn't just about numbers, it's about how you feel when market conditions change. So let's talk through those 4 signs that you may be taking on more risk than you should. First sign, you check your accounts constantly, but how often is too often?
Yeah, Aaron, as an advisor, I'm never going to tell anyone not to check in on your accounts. But if you feel compelled to constantly check in on those
Yeah.
accounts, it might be a sign of several things. It might be a sign that you've got too much risk in your portfolio, or that you just simply don't know how much risk you're taking on in your
Mm,
portfolio. It might be a sign that your overall plan isn't on track, or maybe you just don't have the confidence or don't know that your plan is on track. Or it might be a sign that you may be prone to making some emotional investment decisions.
Yeah, these are all interrelated. We're going to dive into that in a second. Next, so you need to ask yourself, are you losing sleep when the market drops? That being said, though, Dustin, it is really difficult to tune out those stressful headlines.
It is, and it can be counterproductive. So
Yeah.
if you're losing sleep about the market drawing down, what I want you to think of, I want you to think George Costanza. I don't know if you remember, but there was a really funny Seinfeld episode where George Costanza, nothing was going right in his life. And at some point, he just decided that he couldn't trust any of his instincts. So he decided that anytime he had an instinct, he was going to do the opposite of what that
Right.
instinct was telling him to do.
Yeah.
And it's actually, when it comes to investing, this is actually something that can be useful to us because the markets tend to go through cycles. Our emotions tend to track those cycles. Again, that can be counterproductive. And the media tends to amplify those emotions. So fear and fear of missing out, that gets eyeballs, it gets ratings, it gets clicks. So the media on a daily basis, they'll sensationalize even normal moves in the
Right.
market. So
Right.
we want to try to tune out that noise, and we want to try to resist those emotional instincts or emotional investment decisions.
Yeah, I'm so glad you brought that up because that is our third sign that you're taking on too much risk. You've made panic-driven decisions before. This is known as emotional investing, although now, Dustin, you're making me want to rename it like the Costanza curve or something.
Yeah. Yeah. So I think you had a great visual for
Yeah.
this. We talked about emotional cycles in the market. So, for example, when the market is drawing down, we have a very, very normal instinct, an instinct that is telling us that we need to sell. But if we're doing that in the bottom of a market, we're selling at the lowest possible share prices. So instead of that, what we want to be thinking about, we want to be thinking about first of all, introducing some risk management into that portfolio, hopefully before we see these market drawdowns. There are some ways where we can do that, introduce that risk management, remove some of the volatility so that when the market draws down, your portfolio doesn't draw down as deeply. That can help you stay invested and be more comfortable going through these market cycles. The other things you want to think about when we see market drawdowns is rebalancing your portfolio. So buying some assets, maybe like equities while they are on sale. This would also be the time, if you're capable of doing it, to think about adding to your portfolio because you'll be adding
Right.
to it at low share prices, buying at bargain rates.
Right. Right. When you have that financial plan, the volatility is built into it and even allows us to kind of capitalize on that volatility. Last
Absolutely.
sign, you feel pressure to chase returns, aka FOMO.
So this is the flip side of that coin when it comes to that emotional cycle. When markets are high, we're exuberant, we're often overconfident. This isn't the point where we want to be thinking about chasing returns or focused on buying the investments that have performed really well recently. This is the point where we may want to be thinking about, again, rebalancing our portfolio, maybe selling some of those frothy investments, some of those investments that have performed well recently. That'll allow us to take some risk off the table, take some profits, and we can use those profits to buy some investments or some asset classes that at the time are relatively weaker. That'll mean that we'll be buying those assets low.
Mm. So, Dustin, how can working with a financial advisor help us stay in line with our risk tolerance?
Well, working with a good advisor can give you confidence and it can allow you to sleep well. I think it starts with 3 things. It starts with having a plan and knowing
Right.
your plan. It starts with knowing how much risk is in your portfolio and then fine tuning both that plan and that portfolio so that you can worry less.
Right, exactly. When we have a plan that's in line with our risk tolerance, we can just kind of, as you said, have peace of mind, leave it alone. So, Dustin, if somebody would like to sit down with you, learn their own unique risk tolerance, which is different from everybody else's, and create that plan, what's the best way to reach you?
They can give me a call or a text at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
Great. Dustin, thank you.
Thanks, Aaron.